Deep inside 383 Madison Avenue at this very moment, there's a trading desk experiencing the most devastating week in its history. JP Morgan, whose precious metals team just witnessed silver surge from $63.90 to $96.90 in under a month. Their concentrated short bet on silver futures, the single largest short exposure in commodity market history, just bled an estimated $500 million in paper losses in one trading session alone. And the three forces behind this move, conflict in the Middle East, COMEX physical inventory depletion, and a crude oil shock, aren't disappearing tomorrow, next week, or next month. This isn't a poorly timed trade that patience can fix. This is a structural vice that tightens with each passing day. I'm going to walk through the precise arithmetic of how cornered they are and why their suffering is the single most bullish signal in the entire silver market today. Let me lay out the verified foundation before diving into the calculations. In September 2020, JP Morgan paid $920 million to resolve charges brought by the Department of Justice, the SEC, and the CFTC for precious metals market manipulation. $920 million. That wasn't merely an accusation, it was a negotiated settlement, an acknowledgement documented in court. The DOJ case number is available in public records. The charges encompassed thousands of spoofing incidents, the placement of deceptive orders meant to distort prices, spanning 2008 through 2016. 8 full years of proven manipulation on the precious metals desk of America's biggest bank. Everything I'm about to detail regarding JP Morgan's silver exposure exists within the framework of a bank already found guilty of rigging the very same market under discussion. Now, the exposure itself. JP Morgan has historically maintained the largest concentrated short position in COMEX silver futures. The Bank Participation Report, released monthly by the CFTC, discloses the aggregate short holdings of the 4 biggest commercial banks in silver futures. This information is publicly accessible on the CFTC's website. In recent reporting cycles, the top 4 banks have carried short positions totaling roughly 40,000 contracts. Each contract represents 5,000 ounces. That means 40,000 contracts translate to 200 million ounces of silver sold short. JP Morgan has historically accounted for the bulk of this concentrated exposure. Although the CFTC doesn't identify specific banks by name in the report, former CFTC Commissioner Bart Chilton publicly acknowledged that the silver concentration was largely driven by 1 or 2 American banks. Ted Butler, who has monitored this data for more than 2 decades, has consistently pointed to JP Morgan as the primary holder. 200 million ounces of silver sold short at price levels far below today's spot price. Let me calculate what Monday's price action cost them. Silver climbed from approximately $90 to $96.90 during the session, roughly a $6.90 per ounce gain at the peak. Against 200 million ounces of short exposure, each $1 movement represents a $200 million impact. A $6.90 swing translates to $1.38 billion in paper losses in a single day. They may have trimmed their exposure somewhat during the February pullback, when silver retreated to $63.90. That would have been the logical move. Close out shorts at $63 while the price sat 40% below its January high. But delivery figures and subsequent price behavior suggest they didn't exit enough. Had they unwound the majority of their shorts at $63, the ensuing recovery to $96 would have been far more explosive, since their own buying would have accelerated the bounce. The fact that the move from $63 to $96 has been strong, yet not outright parabolic, indicates that substantial short interest is still intact. Here's the weekly damage estimate, assuming they held the bulk of their shorts through February and into March. Silver advanced from $63.90 on February 6th to $94.93 on March 3rd. That's a $31.03 per ounce increase applied to 200 million ounces, amounting to roughly $6.2 billion in unrealized losses across 25 trading sessions. $6.2 billion on a single position in a single month. Even if they exited half the position at $63 and now hold only 100 million ounces short, the damage is $3.1 billion. Even at 50 million ounces still short, losses total $1.55 billion. No version of this math offers them any comfort. And here's where the situation deteriorates further. The expense of sustaining the short position isn't limited to unrealized price-driven losses. They must also pay lease rates to borrow the silver they've sold short. At a 1-month lease rate of 8% annualized, applied to 200 million ounces at $95 per ounce, the notional position value stands at $19 billion. 8% of $19 billion comes to $1.52 billion annually in borrowing expenses. That's $126.7 million per month, or $4.2 million per day. Every single day they carry this position, they're paying $4.2 million just in borrowing fees before factoring in any adverse price movement. At 100 million ounces, the daily lease expense is still $2.1 million. At 50 million ounces, it remains $1.05 million daily. Layer the lease expenses on top of the unrealized losses, and you begin to see why I described this as the worst week of their existence. They're being hammered from two angles simultaneously. The price is running against them while the cost of simply maintaining the position is surging, as lease rates have spiked to 15 to 20 times their normal levels. It's financial death by two blades, so why don't they simply exit? Why not buy back the shorts and absorb the loss? 3 reasons, and this is where the analysis goes deeper. Reason 1, covering 200 million ounces of short silver in a market that holds just 86 million ounces of registered inventory at COMEX would require purchasing more silver than physically exists in deliverable form within the Western exchange system. Their position exceeds the available supply. The moment they begin buying aggressively to unwind, every purchase drives the price higher, which inflates the cost of covering what's left. It's a self-reinforcing trap. Buy to cover, price climbs, remaining shorts get costlier. Buy more to cover, price climbs further. This is the classic anatomy of a short squeeze. The reason it hasn't fully unfolded yet is that they've been managing the position by rolling contracts forward month to month, absorbing lease costs, and leveraging their market-making status to sell fresh shorts at elevated prices, thereby raising the average entry of their overall exposure. But that playbook only holds up in a sideways market. When silver drifts between $20 and $30, they can roll, manage, and suppress indefinitely. When silver is trading at $95 and pushing toward $100, every new short they write to manage the book becomes a fresh liability at a loftier price with steeper borrowing costs. Their management framework breaks down at exactly the price levels we're witnessing right now. Reason 2, covering would broadcast to the entire market that the largest short seller has surrendered. That signal alone would unleash a tidal wave of buying from every participant who's been waiting for precisely that confirmation. Hedge funds, commodity trading advisors, trend-following algorithms, retail traders, all monitoring for the moment JP Morgan capitulates. Because the instant they cover, the single greatest source of selling pressure in the silver market vanishes. Price discovery without JP Morgan's suppression would propel silver to levels the current market has never even considered. Certain analysts project that uninhibited price discovery, free from concentrated shorting, would place silver between $200 and $300 based solely on the supply shortfall in industrial consumption. Whether or not you accept that figure, the directional conclusion is undeniable. Covering eliminates the cap. Reason 3, regulatory and reputational fallout. If JP Morgan unwinds at $95 to $100 after having established the position at $20 to $30, the $920 million penalty from 2020 starts looking like a minor traffic fine compared to the actual realized damage. Shareholders, regulators, and congressional committees would all demand answers about why the bank clung to a position hemorrhaging billions after already having been prosecuted for manipulating the identical market. The optics would be devastating. So they hold on and hope for a dip that gives them a chance to exit at lower prices. But every catalyst that arrives, military conflict, COMEX drawdowns, energy price shocks, makes that dip increasingly unlikely and their position increasingly agonizing. Now, connect all of this to Monday's events and what's unfolding Tuesday. The Iran strikes on February 28th injected a geopolitical risk premium that JP Morgan can't simply trade their way out of. No amount of paper contracts can overpower a safe haven bid fueled by real missiles, striking real military installations in the Middle East. Shanghai's reaction on Monday night, trading volume at 3.5 times the norm with premiums widening to 540 above Western spot, reflects physical buying demand that paper shorts are powerless to contain. You can write limitless paper contracts on COMEX, but you cannot ship paper to Shanghai when Shanghai is insisting on physical metal at $5 premiums. COMEX March deliveries are draining the very inventory JP Morgan depends on to remain functional as a short seller. Every ounce that gets delivered and permanently exits the vault is one fewer ounce available to settle JP Morgan's short contracts. If registered inventory drops to 50 million ounces by month's end and JP Morgan holds even 50 million ounces short, their exposure alone accounts for 100% of all deliverable silver. At that juncture, they either surrender their entire stockpile and are left with nothing, or they fail to meet delivery obligations. Neither outcome allows the position to survive. Crude oil at $85 elevates the production cost baseline, meaning even a silver correction would find support at a higher level than before. JP Morgan's best-case scenario, a retreat to $70, grows less credible by the day because the cost of extracting silver keeps climbing alongside energy prices. The floor is rising to meet them. Here's what the bank participation report data reveals about the trajectory. Over the past 12 months, the concentrated short position has not shrunk in proportion to the price rise. As silver rallied from $29 to $121, the short exposure should have been winding down. Risk management fundamentals demand reducing exposure on a losing trade. The fact that the position remains elevated near 40,000 contracts implies one of two possibilities. Either they cannot unwind without triggering the very squeeze they're trying to avoid, or they're stacking on new shorts at higher levels, wagering on a reversal that never materializes. Both interpretations spell trouble for JP Morgan and signal strength for silver. Ted Butler has written at length about this dynamic. His research, spanning more than 20 years of CFTC data analysis, demonstrates that JP Morgan's silver short exposure has been the single most significant factor in silver price suppression since 2008. His argument is direct: eliminate the concentrated short position, and silver reprices to reflect genuine supply-demand fundamentals. The current backdrop of armed conflict, physical scarcity, and vault depletion is accomplishing exactly that. It's stripping away JP Morgan's ability to hold prices down because every tool in their arsenal, paper contract selling, lease rate manipulation, and vault stock management, is failing at the same time. The $920 million settlement in 2020 addressed conduct from 2008 to 2016. What transpired from 2016 to 2026 hasn't been publicly examined. Yet the pattern of concentrated short selling persisted throughout that entire window, as evidenced by CFTC bank participation reports, publicly available and refreshed monthly. Every report reveals the same concentration, the same outsized exposure, the same structural suppression. Now, the question on everyone's mind: when does the squeeze actually materialize? When is JP Morgan truly forced to cover? The answer: when physical delivery requests surpass available inventory and the exchange can no longer operate normally. That moment is drawing closer through the March delivery cycle. 10,500 contracts standing for delivery against 86 million registered ounces, with the pace quickening. If March deliveries absorb 35 to 40 million ounces, and April brings no restocking, the May delivery window becomes the inflection point. May open interest will face registered inventory potentially below 50 million ounces. At that threshold, a delivery claim rate of merely 15% sparks a crisis. The alternative is that JP Morgan arranges cash settlements at premiums to sidestep physical delivery. They've employed this tactic before, offering buyers a bonus over spot to accept dollars rather than metal. But at $95 silver, the premium needed to persuade a buyer to take cash over increasingly scarce physical metal keeps escalating. At $60 silver, a 5% premium amounted to $3 per ounce. At $95, a 5% premium is $4.75 per ounce. Across millions of ounces, those premiums balloon into billions. Yet another cost, piling onto the hemorrhage. The gold to silver ratio sitting at 56 and tightening toward the historic 55 benchmark means gold is dragging silver upward independently of JP Morgan's position management. Gold trading above $5,400 and climbing on safe haven flows. Silver tracking it at an accelerating pace. This ratio compression is a market-wide force that no single institution can counteract because it reflects global capital allocation tendencies, not the stance of a single desk. Let me close with the figures that count. JP Morgan's estimated exposure, roughly 40,000 contracts, 200 million ounces short. Current paper loss at $95 spot, approximately $6.2 billion on the full position. Daily lease expense at 8%, approximately $4.2 million COMEX registered inventory. 86 million ounces and declining daily. March delivery commitments, 52.6 million ounces. Crude oil at $85, lifting the production cost floor. Iran and the Strait of Hormuz with no resolution in sight. Shanghai premiums at $5.40 and widening. Gold to silver ratio at 56 and narrowing. Every single one of those data points worsens JP Morgan's predicament. Not a single one provides relief. And each day that passes without covering tax on another $4.2 million in borrowing costs, while exposing the position to further price spikes from forces beyond their control. The $920 million fine addressed silver manipulation from 2008 to 2016. The current position is burning through multiples of that penalty in unrealized losses every single month. At what stage does the board of directors at America's largest bank conclude that the silver short exposure poses an existential threat to the institution and direct the desk to cover regardless of market impact? That decision point is approaching. The arithmetic guarantees it because positions that drain $4 million a day while the underlying asset appreciates and deliverable supply evaporates do not unwind quietly. They unwind violently. And when JP Morgan's silver short position finally unwinds, it will represent the largest single covering event in the history of commodity markets. Every data point I referenced is publicly accessible. The DOJ settlement is a matter of public record. CFTC bank participation reports are published monthly. COMEX registered inventory is updated daily. Lease rates are reported by the LBMA. Oil prices are available on every terminal. The 2020 settlement of $920 million is documented in court filings accessible through Pacer. Confirm all of it. Don't rely on my word for the largest short squeeze setup in silver market history. Rely on the data, and then observe what unfolds when the mathematics finally catch up to 383 Madison Avenue. Stay alert. I'll be here when it breaks.